You can backtest 100 strategies, spend weeks in the spreadsheet, and still end up with nothing that actually works. I've done it myself, and I know this too intimately. Today, I'm going to walk you through what I've learned from testing hundreds of strategies, what actually matters when building something that's tradable, and how to avoid the curve-fitting trap that ruins most traders before they even start. For those of you new here, my name is Mark Anderson. I'm a construction worker turned zero DT hedge fund manager. I've traded over $100 million in zero DT premium and traded over 1,000 consecutive market days. And if I could sum up one thing I've learned through all of these backtests, it's not about finding the best strategy. It's about building one you can actually run over the long term. Let's start with the truth. Most backtests are lying to you, not because of bad data, not because of malicious intent, but because they're optimized for beauty, not for durability. They're the Tinder profiles of trading. Airbrush, cropped, and filtered to perfection. You run a test, you tweak a parameter, and you filter down to only the best trades remaining. And boom, you've got a system that looks like it'll print money and you can retire tomorrow. But here's the catch. If it only trades once a week and has 20-to-1 risk to reward and a win rate of 98%, that's not an edge, that's a mirage. So what actually matters? Let me give you a short list of the stuff I use to prioritize every time I evaluate a strategy. 1, the frequency. If it doesn't happen often, it's hard to trust. The more trades, the faster you know if your assumptions are holding up. 2, realistic assumptions for slippage and fill quality as well as commissions. If you haven't placed this trade in real life and seen what happens, you're just guessing. 3, understanding logic. If you can't explain why this trade works to someone over coffee, you don't understand it well enough to run it, and it will break. 4, execution simplicity. If it takes 15 more minutes a day to monitor or adjust what you're doing, you will burn out. The best trades fit in your life without hijacking your day. 5, trade ethos matches your behavior. Don't build a trade that's based on waiting all day for the perfect moment, only to scalp a few minutes in and out. That's not a system, that's a contradiction. Let me show you one backtest I pulled recently, and on the surface, things look amazing. 98% win rate, CAGR of 3.4%, and a small max drawdown of 1%. Over $11,000 in profits on a $100,000 starting account. But dig just one layer deeper, and you see some of the problems. It only has 380 trades across 4 years. That's once every 3 days roughly. Way too sporadic to depend on this system as a standalone. 1 trade per day, no diversification, and no redundancy. Massive risk to reward imbalance. A single loss can be $705, which could kill 15 to 20 winning trades. And the exit logic fights the trade. You're using time-based filters to enter, but closing out right as theta decay is working in your favor. Why? That's important. This entire setup was sold by a guru as a can't-miss method. If you walked into a hedge fund with this backtest, they'd laugh you out the door because it's not durable, it's not executable, and it showcases that it's not a real strategy. Backtest don't just test trades, it tests you. Every time you swipe to a new setup because the old one didn't look exciting enough, you're training yourself to chase instead of build. You're feeding that dopamine loop. What's next? What's better? What's hotter? But the real edge, the one that scales, it's boring, it's repeatable, and it builds through consistent, unsexy reps day after day. You don't build successful portfolios from 100 strategies. You build it from one strategy run 100 times with tight controls, clear logic, and full alignment between design and execution. So here's my real take. Hedging is part of the capitalist system of your portfolio. If your hedge doesn't increase your return, it's not doing its job. A trade only matters if it adds more value than it costs. And the strategies that survive are usually the least exciting. They're not sexy. They don't shoot the lights out. They just show up day after day. They hold up to real execution, they match your mental bandwidth, and they give you enough shots on the goal to learn and adapt. So the next time you find a backtest that looks too good to be true, it probably is. If this was helpful and you want to see more breakdowns like this, hit the subscribe button. I share strategies, mindset, and real-world execution lessons from inside our fund, so you can build systems that last. And hey, if you're serious about becoming the kind of trader who builds, not chases, this is the place for you. Thanks for watching.